Well, hello, folks. It's T. Brian Hayes here from Hayes Advisor Group with your February 2016 educational update. In this video, we'll talk about some of the economic headlines that influenced markets in the last month and give you some insight into what they might mean for you as an investor. As always, please stay tuned at the end for a required disclosure statement. January was another tremendously volatile month for stocks. Investor sentiment turned negative on more bad news out of China and plummeting oil prices. Now let's take a look at some of those headlines. A first look at fourth quarter economic growth showed us that the economy hit a soft patch in the final months of 2015. Gross domestic product grew just 0.7%, which is a disappointing drop from the 2% we saw in the third quarter. Q4 GDP growth will be revised 2 more times as data comes in, and it's possible that the final result will be more optimistic. However, we're not expecting a ton of improvement. So why did the economy slow down? Well, we can attribute a lot to the drop to lower business spending and weak global demand. However, the data also shows that U.S. consumers aren't spending the extra money they save from gasoline. In other news, the Federal Reserve met in the last week of January and declined to raise interest rates again. It's not a big surprise given the challenging economic and market conditions, but some experts don't think that the Fed made the right call here. With so much uncertainty in the markets, a rate hike could have given investors more confidence in the economy. On the other hand, inflation remains low and economic growth is modest, so the Fed might hold off on further rate increases for months. Earnings season kicked off in January, and the overall picture is one of lower earnings and lower revenues. That's not a surprise because we know that American firms are facing major challenges from a slowing global economy, a strong U.S. dollar, and weak commodity prices. But more than 2/3 of firms that have reported so far have been able to beat their earnings targets, which tells us that managers are doing a good job of managing expectations. On the positive side, a gauge of manufacturing activity blew away expectations and came in at the highest reading since last January. Manufacturing, a backbone of economic activity in many parts of the U.S., seemed frozen after several reports showed that factories struggled with demand. This new data is a refreshing change, and we're hopeful about manufacturing this year. That's it for the February educational economic update. Now let's take a look at the financial markets for January. Volatility increased for the month of January, and that certainly affected the markets. In fact, this January recorded the S&P 500's 9th worst January in history, and overall it was the worst start to the markets in history. The combination of a CVI over 100, the longevity over 100 days in a transitional environment, and a clear break in the primary bullish trend is consistent with a shift to a bear market environment. Canterbury portfolio thermostat has been in one of the transitional bearish market states for the last 101 trading days. That began when volatility spiked last August. And volatility is measured by the CVI is currently over 100, as we said. So for reference, a CVI reading of 75 or lower represents a low risk, efficiently working marketplace, meaning a bull market environment. When we're above 75 and up to 90, it's considered neutral, but a CVI above 90 means that risk is very high in the markets where markets are not operating efficiently. This is why you're seeing 200, 300, even 500 point swings in one day in the Dow happening on a regular basis. This is not healthy, and these types of days are a common occurrence during unstable bear markets, which is what we're in now. There's no question that the primary market environment made an abrupt shift for the worst last August. So markets are very risky right now, and many indicators are showing that the markets are likely to head a lot lower. This is the time to make some adjustments to your portfolios, become much more conservative. The accounts that we manage for our clients began to make these adjustments last August when market conditions changed, and you can see how good that decision was as these accounts have not taken the hits in the market in January. Most of the accounts are flat or even up a little bit for January, which obviously is a very good thing. Again, the goal during this time of elevated risk is to stabilize the portfolio and not take these extreme hits. From this point, a recession is likely, and markets will likely continue their wild swings with a downward trend. Again, market conditions are signaling that more losses are probable with potential big losses. So now's not the time to get or stay defensive, not to be aggressive. If your portfolio took a big hit in January, you may want to make some adjustments or feel free to give us a call for some assistance. As always, please continue reading the weekly market updates that we send out, and that'll give you a good idea of where things stand and what's going on. Finally, let me remind you of the college-style retirement planning course that's coming to Kokomo in the next few weeks. This is a good retirement education course to be able to sit in and learn everything from A to Z about retirement planning. So if you'd like to come to that class, it's over a 2-day period, 3 hours each day. feel free to give our office a call, and we'll get you a reservation made. So again, this is T. Brian Hayes signing off for the February educational market update. If you have any questions at all, feel free to give us a call at 1-800-939-1603, and I'd be happy to talk to you then and give you any help that you need. So signing off for February. We'll talk to you again in March.